Oh, my alert, as soon as we go live, all my alerts start pinging. I apologize if that was kind of like, if it sounded a bit techno. My trading view alerts, I need to change them back. I changed them last week and they sound absolutely awful. And every time they ping off, I'm like, where did that come from? So welcome guys. Today's session is a strategy development session. These are generally quite chilled, hence why I'm sat down. Usually I'm stood up presenting, but I'm a bit tired today. I've been going back to the gym recently, so yeah, I'm a little bit battered. I can just see the Rango in Discord's put 30 Kieran. Why didn't you invest in tech stocks when you were 8, bro? That's it. I actually bought Bitcoin in 1989 before I was born, so I'm actually officially a billionaire these days. But anyway, jokes aside, these sessions are primarily designed to give you guys a little bit of an insight into different variables that you can use, or different variables that you can investigate in your trading strategy that perhaps you didn't know were kind of there or even a thing. I run these on a weekly basis. I like to take somebody who's in the audience to take their Darwin, do a live analysis, and give you guys kind of feedback of things that you can improve, things that you can look out for. Like I say, I'm looking at variables from a statistical perspective, so it's not always things that you would necessarily look for when it comes to, I don't know, technical analysis or checking something whilst backtesting or checking news events and all those sorts of good stuff. I am a trader. I've been a trader for the past 6.5 years, I believe. Times are pretty sketchy in my head because I was trading crypto for a couple of years before I become a trader. So I don't actually know how long it's been. But before I become a trader, I was actually a data analyst. So I love data, metrics, statistics, anything that kind of gives you black and white evidence of performance or something that you can kind of build patterns from. I thrive in it. I love it. So these sessions are designed to kind of get the best out of me from both perspectives, from a statistical perspective, using my pattern recognition from a data analyst background, and using, like, translating that into being a trader and how to use that information to try and improve your strategy. So I'm just going to ask if there's anybody, whether you're watching on X, YouTube, or Discord, if there's anybody who would like me to take a look at their strategy. I would rather do it with somebody who's in the session, because at least then you have something to go away and think about, and you have some ideas. Whether or not they're actually useful or provide any benefit long term, I don't know. That's not the purpose of today. The purpose of today is to literally brainstorm, look at different variables that you don't usually, look at, and see if we can figure out anything that might help you moving forward. So I'm going to ask somebody, or I'm going to pick on somebody, because there's a couple of guys in the Discord whose records I already have bookmarked. Who I'm talking about, guys. So I will pick on someone. Ideally, I like to have somebody with a record of at least 6 months. If it's not 6 months, I would say 3 months is the minimum, like the absolute minimum, because anything under that, it's very difficult to quantify and say that the data is accurate over an extended period of time. Easy Trading is saying that they have no voice. I'm guessing that means you can't hear me. Can somebody confirm? Rango, could you confirm that you can hear me in the Discord, please? If anybody's watching on X or YouTube and also can't hear me, please let me know. Okay, Rango said he can hear me fine. It does all show that I'm speaking. I just noticed how creased my top is as well. Apologies. I thought I was presentable today, but apparently not. Apparently apparently I don't own an iron, but it is what it is. Rango, I might pick on you because you have we done your Darwin before? I don't know if we've done your Darwin in one of these sessions. I feel like I might have done, but I'm not sure. I mean, to be fair, it's not like you need any help or guidance, really. But actually, sometimes those sessions are the best. No, never, but I don't know if I'll have the time to follow everything. That's cool. I mean, nobody else has been brave enough to put their Darwin in, so I think I'm going to pick on you, because A, I know your record's long enough, and B, maybe other people can take something from it because you're actually in DarwinIA Gold. You've been paid, you've had allocations, so you're kind of the perfect example of somebody who we look at for a successful trader, right? So let's take a look at my bookmarks. I already know your Darwin off by heart, but it's too late in the day to be really using any brain power. Where are you? Have I not even got you bookmarked? Oh no, I haven't even got you bookmarked. Oh, what an idiot. Why you got to give it to me for? I'd have remembered that. I literally post about you on Twitter all the time. So, a little bit of background. The Rango is one of our Discord members, or one of our more active Discord members, I should say. Super helpful with the community. He's always answering questions, and you know, from his track record, he's just a fantastic trader. Let's take a look at how long your record is. Okay, so it turns 2 years old next month, which is great. This is kind of the perfect time to do this, actually. So I'm glad you're here, and of course I know you can't stick around and watch the whole thing. Obviously, it'll be recorded. It'll be on YouTube and X anyway. So if you do want to look back, you can. But also, I think this is probably going to be more beneficial for other people, because people do always ask me, can we take a look at successful traders? And I know we do interviews and stuff, but we're not always digging into actually what makes them profitable from a statistical perspective. So I think this this session will be really interesting. So let's just recap kind of the for sure, I'll watch it again. Good lad. We'll just recap kind of from a bird's eye view. So your all-time high quote was roughly 48%, currently sat at a 42.97% return over 2 years, which is fantastic. Outperforming the S&P on average anyway, with a better drawdown. So that's the main goal as a trader, right? Can you outperform the leading investment vehicle in the world with better risk-adjusted returns? If you can, fantastic. If not, that should be your first goal as a trader. You're currently managing 275,500 from external investors. And that's spread between 12 investors, so that's quite good. Usually when you've got 10 investors, you're looking more sub 100k, but that shows to me you've got some decent size guys backing your strategy, and you've also got currently 405,000 euros in DarwinIA allocation, which is sick. So you've got 547,000 overall. Is that right? The euro to USD conversion rate always sends me loopy. PGLM, let's stick you in here also. What we do in these sessions as well, because not a lot of people are aware of this, even if you have a Darwin on Darwinex 0, you can also view that Darwin on Darwinex.com. There's way more statistics and metrics that you can look at. There's like custom things that are built on there, which are great. And so what I usually do is do the base analysis on D0, and then I'll show you how to view your Darwinex 0 Darwin on Darwinex.com. I feel like the amount of Darwin in that sentence is way too much, so I apologize. As we go, guys, if you do have any questions, just pop them in the chat, and I'll go through them as we go through. I'm feeling quite chilled today. I don't know if anybody can tell. I'm in a good mood today. So first of all, let's take a look at what you trade. My mouse is being all weird though. So you're heavy on the indices. 2,000 trades. That's a lot. How many trades you got over the 3,452? You're not an EA, are you? You're not an EA trader. I don't feel like you are. Oh. Divided by 12. I don't even know why I'm doing this. We literally have the statistic right here. So you've got an average of almost 7 trades a day. EA trading in every universe. I always thought you was a manual trader, but okay, that's interesting. These sessions are a little bit more difficult when it's somebody who's trading with an automated strategy, just because a lot of the things that I usually go through aren't always accurate. Like there's a lot of trader behavioral things that I look at, which kind of doesn't relate to somebody who's trading with a robot or with an expert advisor. Just because obviously there's no human interaction involved most of the time. Of course, I know there's traders who have kind of a combination or a blend of both. So let's go back to, but yeah, you're quite heavy on the trade front, just under 7 trades per day on average. That's, you know, that's fairly heavy, which leads me to, or would lead me to believe that you're an automated trader. So 60% of your trades are on indices. Let me just mute my notifications. 60% of your trades were from indices, 25% from FX, and 16.5% from commodities. So straight away, what I would be looking at here, which I don't know if you've already done, just because of the sheer massive trades that come from indices, but I would be looking at this and saying, is it even worthwhile trading FX at this point? Um, Obviously, your record is 2 years long. You haven't made any return trading FX. You've got a sub 50% strike rate, and that's a decent amount of trades. It's not like you've taken, a handful. It's over a great period of time. And there's quite a large sum of trades as well. So for me, again, I don't know if you've already done this, but I would be looking to remove FX from my strategy for two main reasons. A, it's less of a headache. Not just not I and I don't mean FX, but I mean the more assets that you trade or the more asset classes that you trade, the more of a headache things can be. Obviously, you've got more things to track, you've got more things to optimize if you're trading with a robot. You've got more risk exposure and all of that sort of stuff. So if you can do less work for a higher reward long term, it makes sense, right? Less stress, more money. That's what everybody or every trader should be striving towards. The second thing is it will actually lower your risk exposure, because the things that calculate VAR isn't just position sizing. And I'm sure you guys already know this, especially you, the Rango. You've been around long enough to know this already. But there's different things that go into VAR. So volatility of assets, trade frequency, how long you hold positions for, and your position sizing. So the more assets that you trade and the longer that you hold these trades, the more trades you take, also all those sorts of things will increase your value at risk, even if it's just slightly, right? If you cut out a certain asset or a certain asset class that's underperforming, and like FX, over a course of 2 years, and you haven't generated a return, why not save the exposure that you take on the asset that doesn't pay and put it elsewhere? Either increase your exposure on indices or just basically keep it flat. And what that will do is it will lower your value at risk. Your risk multiplier will increase because your VAR will come down, and it's like a balancing mechanism. So your VAR, and again, Rango, I know I'm probably sounding like I'm teaching you to suck eggs here, but this is more for other people who are watching. It's basically a balancing mechanism between your risk multiplier and your value at risk. So if your value at risk decreases, your risk multiplier, which is what takes your trade size from your signal account to your Darwin, that will actually increase. Now, usually the only way to make that change without changing your strategy is by adjusting your position size. So start trading more, taking more risk on. Your value at risk is going to increase because you have a higher risk exposure, and therefore your risk multiplier is going to decrease. Okay. But in this case, we're looking at reducing the trade frequency, reducing, different assets, how long you hold those certain trades, because there's going to be no trades there. So your value at risk is going to dip slightly without touching your position sizing. So your trades are still trading at the same size at signal account, but they're going to be tuned up slightly because the risk multiplier will take into account the dip in value at risk. The risk multiplier will increase. And so the trades that you're still taking on your indices trades or your commodities will be slightly higher. So actually your Darwin return will benefit from that over, another year or so, because your return might be slightly higher because your Darwin's now tuned up a little bit more. Let's see. Rango said, good point, but I've seen that sometimes Forex strategies counterbalance the indices when they are losing. So it's more about balancing the portfolio than having real gains. No, it makes total sense because my VAR is high because of that. Yeah, I mean, that's the thing, right? Is that you've always got to have a reason for making the decisions that you do. And I get that. I just need to switch something off. This is the problem with being a trader, right? Is I have to stay focused. There's so many times on these sessions when my trade alerts ping off. Where's Discord? Let's bring that back up. But I guess you guys can feel happy in the fact that I'm a trader and I'm not just talking at my backside. Why has that happened? Ah, I get it. Okay, sorry, back in the room. Yeah, so if you're using it as a portfolio hedge, I guess is the best way to explain it, then fair enough, that makes sense. And if you've already got that baked in, it's just, does that play out long term? And it might be worth running a sim test or what have you, like a little experiment to see what works best, running it as a hedge or getting rid of that hedge, and letting the risk exposure increase slightly on the others. Because to be honest, it doesn't really look as though you're over leveraged on anything anyway. I mean, we'll get to your VAR in a moment, so we'll take a look at that. Commodities, you know, decent win rate, lower amount of trades, but still a decent return from that. I mean, it looks like you're trading one asset for each one, so I'm guessing you're doing, in fact, I'm going to guess it's like NASDAQ, pound, or pound US, and gold. I'm going to go out on a whim and say that's what you're trading. I feel like you're a pound kind of guy, you're not a euro guy. But yeah, decent win rate, a decent return, but really your bread and butter is the indices. Now, again, going back to this, I would presume that you're using this more of a hedge as opposed to generate a return. But it's kind of like, okay, is it worth the risk? Because if you cut half of your whole trades out and just focused on the indices, again, your risk exposure would be higher. Therefore, you'd make and generate a higher return. But again, I get it if you're using it as more of a portfolio balancing mechanism. It's smart. I do that sort of stuff. Sometimes I don't usually do it with asset classes, but I get it completely. Can you look to the assets from Darwinex? I can open it for you. What do you mean? Assets traded. Yeah, but it's locked at the minute. So you would have to change it in the settings. Don't worry about it, dude. I mean, it's going to show exactly the same information because you only trade one asset per asset class, so it doesn't really make too much of a difference anyway. But we can come back to that if you make it available. The next thing is not really. Yeah, don't worry about it. The next thing is trading time distribution. So this basically, it's a decent metric, but it has some flaws. The first flaw is that it doesn't actually show the amount of trades. It shows the amount of trading decisions. So where it says 2,903, you actually haven't taken 2,903 trades. You're looking at half of that because it's counting an opening and closing position as a singular trade. The other flaw with this, especially if you're trading, you know, with an expert advisor, is that it doesn't differentiate whether you are opening or closing a position at that time. So whilst your second biggest return or your best risk adjusted return, or not risk adjusted, frequency adjusted, I guess, where you like, as in from your lowest amount of trades to your biggest return would be the Asian session. Because if we look at the difference between the return in the US and Asian session, it's like less than 1%, right? But if you look at how many trades built up that return, let's take a look. I might have to refresh my page. If we consider how many trades built up that return, it took you 1,300 to build it in the Asian session. It took you 2,500. That's strange. Okay, interesting. Now that you've done that, it's shown that you're trading more assets. Okay, I didn't even know that was a thing. Okay, oil, gold, Dow, Nikkei, SPX, Nasdaq, DAX, pound yen, euro yen. Okay, so it's even more interesting because if we split it down, the NAS is your bread and butter, really. Yeah, I mean, I still stand by what I said. And I would say to everybody taking the portfolio hedge out of the equation. It just doesn't, to me, it doesn't make sense to trade these pairs. They just don't pay off overall. But again, I understand if that's what you want to do to hedge your portfolio if the indices aren't performing well. I get it. So yeah, going back to the trading time distribution. Again, the floor doesn't tell you whether you're opening or closing a position in there. So if I set a TP, for example, and it gets hit in the Asian session, it's going to show the return for the Asian session. But actually, all of my work was done, you know, maybe earlier in the week or maybe a different time of day. So whilst it shows you when you've generated the return, it doesn't actually say, okay, well, the work pays, like you need to be entering at this time of day. So for an EA trader, it kind of really doesn't make sense to kind of put too much emphasis on this or look into it too much. The only thing that you can really take away from it is you shouldn't be closing your trades in the European session. See if you can run them slightly further or cut them earlier because it's clear that you make a better return elsewhere. But again, Nothing's broken here. There's nothing that's too out of reach. Like, I wouldn't be looking at this thinking there's an issue. Again, it's more for kind of the manual traders when you see that their performance dips in the US session, and you kind of think, well, why would you not finish your day earlier? Take the rest of the day off, and go out and enjoy the sun rather than trading a session that you do your ass in. So that's what I usually derive from that. Again, return distribution by day of the week. This is one of my favorite metrics. But having said that, again, it's one of those things that is way more relevant to somebody who's executing from a discretionary perspective. And the reason being is because I find this measurement is one of the best things to view somebody's behavioral patterns. You can pretty much derive what somebody does on a day-by-day basis, or the difference in their behavior on a day-by-day basis, just by looking at this. And I know it sounds fluffy, but believe me, I see it time and time again. And you can kind of work out what cycle a trader is in. So for example, I see a hell of a lot of times I see somebody who has a great Monday, really poor Tuesday, Wednesday, Thursday, and then they also have a great Friday. And I put a lot of it down to, and I speak to these guys, they spend the weekend clearing their charts. They go, do all their analysis. They journal. They make sure they're prepped for the week ahead. They might have had a bad week last week, so they're motivated to get back, get back in the green. They might have had a fantastic week last week, and so they feel fresh coming into the week ahead. They perform really well on Monday because they've done all their journaling. They've done everything that they should be doing. Coming into the Tuesday, they go, oh, well, I've cracked it, right? I'm not going to do my journaling. I've had a great day. It's what it is. Going to be a good week again. And then all of a sudden, they don't do the things that got them to where they were initially. And then you see the performance dip, and it dips and it dips and it dips, and it stays like that all week. By the end of the week, they kick themselves up the rear end again, and they say, right, I'm not going to finish the week like this. We're going to have a big day. They do everything again that they should have been doing, and they have a great Friday, and they rinse and repeat that cycle. And believe me, I know it sounds like I pulled that out of my head, but you see it so many times. And when I suggest it to people, a lot of the times people go, yeah, actually, that kind of sounds like what I do. Also, a kind of really weird one is like, if a trader has a specific poor day, like they might trade really well on Monday, Tuesday, Wednesday, Friday, and their Thursday might be really poor. I say, okay, let's look at that. Let's look at that variable in isolation. Let's check what you do on a Thursday compared to the other days of the week. Do you do something different when you're supposed to be executing your trades? Something as simple as, if you're active in the London session, do you take your kids to school on a Thursday? If you do, okay, well, how does your behavior change? Does your routine change? Does that affect your execution? Does it affect your trade management? It can be something so small in your routine as a trader that completely knocks you off and you don't even know about it. Now, with an EA, it's a little bit harder because it does come down more to the technical edge as opposed to the actual trader's behavior. Because, of course, again, there's no kind of behavioral element to the EA other than the person who's, running it and switching it on and off. Now, you can clearly see there's a big discrepancy between Tuesday, where you've generated a minus 4.5% almost, and a Wednesday where you've generated 27.5%. So that's a discrepancy of over 30%, which is pretty heavy. Now, I don't know what sort of strategy your system trades. Like, I don't know if it's a mean reversion system or a breakout system, but quite often what you see with things like this is that if it's a mean reversion system, generally certain days of the week, it's going to perform better than other days. If it's a trend following system, again, it might work better on a Monday because the Monday, or generally, if it's a bullish week, you're going to have the low of the week on Monday and the high of the week on Friday. Mean reversion systems, your Tuesday, Wednesday, Thursdays might perform better because you're going to be catching the highs and lows of the week. So you can kind of find technical edges from it, and maybe you go, okay, well, my system doesn't perform on a Tuesday, so I'm going to switch it off on a Tuesday. Again, I'm not advising you to do this. Obviously, there's a lot of work in the background you would have to do to go in and actually analyze the trades and see if that would be worth doing. But what I do suggest, and to the guys who come to this session a lot, you'll know I always talk about doing this, is implement. And I do think every trader should do this to a degree, is every trader should have a risk barometer, which is kind of just a barometer of how much risk you're allocating to any given position. And this is applicable to expert advisors or manual traders, right? So you go, where is my expected value the highest? And where is my expected value the lowest? And we plot it separately on the risk barometer. Now, your risk barometer has a baseline of 1, let's say. And it doesn't have to mean 1% risk per trade. It doesn't have to mean that at all. We're just using the baseline value of 1. We then find where's your highest expected value position. So for you, Rango, you're looking at Wednesday is a variable that gives you your highest expected value because it's your highest returning day by a landslide. We're going to ignore trading time distribution because I don't think it's too applicable. If we take a look at your highest performing asset, which would be the NDX, I believe. Yeah, so NDX. So just these two variables, right, which is day of the week and the asset. The NDX on a Tuesday is your highest expected value. Now, if we compare that to, is it Euro Yen is your worst? So Euro Yen, where you've had almost a 2% loss overall on a Tuesday, which is your biggest losing day, that would be your lowest or least expected value, right? So should you be trading with the same risk on those positions? Probably not. Now, again, this is where it gets really tricky if you're trading with an expert advisor because you have to have an element of coding experience. I don't know if you do. I don't know if this is custom built by you, Rango, or if you've had access to this elsewhere. But you would have to be able to code these parameters in. So I get it's not as easy as me just saying, oh yeah, well, do this, do that. But I would argue that you shouldn't be trading the same risk on Euro Yen on a Tuesday as you would on the NASDAQ on a Wednesday because your expected value is far, far higher. So that might push on the risk barometer, that might push your risk to a baseline of 1.25 for NASDAQ trades on a Wednesday. Whereas Euro Yen trades on a Tuesday, that might push the risk barometer down to a 0.75. Again, I'm not talking risk percentage, I'm just talking baseline. But of course, that would mean an increase of risk and a decrease of risk. And you've got to think of yourself as a bit of a poker player here. So I always use this analogy, right? And a poker player is never going to bet the same on every hand that they play. They're going to fold. They're going to bet larger size when they know that they've got a good hand. And they're going to play the odds, right? Based on the hand that they've been dealt. And I feel like every trader has to implement that to a degree. Every trade, every setup is different. It has a different probability. It has a different expected value, and you have to bet accordingly. So the Rango said the weight is different across assets based on the strategy parameters and analysis. Okay, so you're already implementing that sort of thing, is what you're basically saying. Or do you mean like the portfolio weight is different across each asset? Sorry if you can hear the doorbell. My kids have just got back and they're ringing the doorbell. Okay, the portfolio weighting is different across assets. So I'm guessing, like you say, when the Nasdaq's underperforming, you might increase exposure to something else. In terms of like you might increase exposure to FX and stuff like that. So let's take a look at your strategy statistics. Doing this with single trades becomes difficult to predict. Yeah, of course. Again, a lot of what I'm saying, it's difficult because it's probably not going to be as appropriate to you as it would be to another trader. But I'm hoping that other people still pick up kind of what I'm saying and seeing how they can use this to improve their own strategy. It's always hard. I always struggle with automated system doing the analysis. I feel like I need a sidekick to do it with me, just because there's a different level of thinking, right, that's involved, and a different way that you would approach things. But anyway, sorry, I saw MetaTrader kicked off another trade, so I was wondering what's going on. I've got 4 screens, by the way, so if you see my eyes going up, down, left, right, it's because I'm looking at one of my other screens. So like as we said earlier, you have an average of just under 7 trades a day. You have 64% long exposure, which is interesting, but I'm presuming that's because you're heavy on the indices. So generally over the past 2 years, it's been up only, apart from a few little blips that we've had. You've got a 43% strike rate with an average payoff of 1.52. So basically for every dollar that you make on a winning trade, every dollar that you lose on a losing trade, you make $1.52 on a winning trade. Meaning that you're, even with a sub 50% strike rate, you still have a positive expectancy, which is great. Average losing trade is 9 hours. Your average winning trade is actually double that at 18 hours, which again is great because you've got a duration ratio of 1.88. Nobody wants to sit in bleeding positions, and what I mean by that is getting into a trade and then your losers taking twice as long as your winners to play out. It probably means you're going to have a negative expectancy per position or a negative risk to reward, but also it means that you're going to be sat in pain for God knows how long. So it's always better to have a positive duration. Not too much to go over here. Usually this is more sporadic, and again, you can kind of build up a thesis of when you should be monitoring your positions. So I always say you have like a hot zone or a danger zone. And it really does depend on the style of trader that you are. So a swing trader, for example, they tend to have less wins down here. So just for reference, this chart measures how long you're in the market by against how many pips you take on your trades on average. And then each square, you can see it says, for example, in this square, 143 trades. So there's been 143 trades that you've taken 0 to 10 pips in profit, and you've been in that trade for under 30 minutes. Now, like I say, for swing traders, generally they're going to have less winners the less time they're in the market and more losers. And that's, of course, because they're probably wrong on the positions faster than they're right. So they generally have like a danger zone here. So I always say for swing traders, you're kind of watching the market for the first 30 minutes, maybe 2 hours, 4 hours, dependent on what this chart shows, because that's your danger zone. As you get out of there, your expected value changes. So wherever we're looking on here, the trade duration, so whichever line we're looking at, so we've got 30 minutes, up to an hour, up to 2 hours, up to 4 hours, and so on and so forth. Each one, you kind of have your own expected value on. And the reason I say that, and I'm not going to do it with yours because you've got too many trades to do it with, but let's say your overall strike rate is 43%, but then we look only at the trades that you're in for 0 to 30 minutes, and you can see that your strike rate there is 10%. Okay, well, you've got a lower than average expectancy in that time zone. So that's your danger zone. In that first 30 minutes, you only win 10% of your trades. So any trade that's closed within 30 minutes, it's likely to be a loser, right? And you'll notice that your expected value will either increase or decrease the longer that you're in the market. Now, again, more for manual traders here or discretionary traders, but it can really, really help you with overcoming things like greed, FOMO, struggling to hold winners, because you can look categorically and say, well, I'm 4 hours deep into a position, but generally when I hit 8 hours, that's when my expected range gets really, really good. And we're about to get to that level. So you can optimize your trade management by looking at this. So Rango said it is right 100%, but I want to close trades that don't go in the direction it should be. I have a heart to take care. So I'm guessing by that you mean that you have strict invalidation criteria. So if it doesn't start moving in your direction or the direction that you want it to go in, you'll start closing it, which again is the smart thing to do. And again, would more or less, yeah. So that again creates your danger zone, right? So if you do that within the first 30 minutes of being in the market, you'll find that that's probably your danger zone. And, even if it's from manual intervention where you'll close the positions, well, cool. That's because that first 30 minutes is where, or first 2 hours or whatever time frame it might be, is where you decide, is this trade going to play out or is it not? After that, you go, okay, well, I've made the decision. We're past my danger zone. I'm going to let the trade run. Either run till target or run till it hits a certain level, and then we'll close it. Now, this is interesting. So your maximum positive and negative excursion, or as I call them, favorable and adverse excursion. So if I do sometimes alternate the two, so I apologize. But what's interesting about yours, for those who are unaware, this shows how far your trades run against you and how far they run for you. So what we can do is we can optimize stop placements, entries, and all of that good stuff, and even targets. The only drawback to this chart specifically is that it doesn't measure your excursions outside of the trade. So what I always do is I track this statistic manually anyway on top of this. because if I'm closing a trade and then it runs 300 pips further in my direction, I want to know about it, right? So I always track it outside of this as well, but this is a great baseline to start if you don't already track this. Now, what I can see straight away is that you aren't letting trades run the way you used to. I don't know why that is. Only you're going to know the reason as to why that is. But I would ask yourself, why are you doing that? Because you had some monster positions here. It's also a shame that you can't zoom into this chart. It's a little bit annoying, but the only thing to counteract that, and which might explain it as well, is your maximum adverse excursion is much, much lower. So I don't know if you lowered your risk on your end and you're trading smaller size now. I don't know if that's the case. I mean, this does show at Darwin level, so, or if you've made some adjustments to your system. It's just this behavior here since the beginning of this year is completely different to, well, that's from February, completely different to this here and this here. So I don't know if you wait for certain market conditions and that's when you decide to allow trades to run. Okay, so Rango said, yes, lowered my risk plus some tweaking with money management. Cool. There's kind of a theme going here where, which I really like, is that you're actually active or already in trying to improve your strategy. So that's great. At the beginning, I was just trying stuff to understand how Darwinex works. Okay, we see that a lot. There's a lot of track records that are kind of like a little bit sporadic to begin with, or you're kind of looking at it going, I don't know what they're doing. And a lot of the time, it is just that people are figuring it out, seeing how things work, and getting used to Darwinex. Okay, I was expecting much worse when it came to your VAR, to be completely honest. Just because you said it was so high. 9% isn't that bad. It's not high at all. The only issue with your VAR is that it is quite sporadic's not the word. What's the word? It's quite volatile. Let's use the word volatile. So you can see at the peak it was 28%. At the bottom it was 5%. So you do have quite a thick band for your value at risk. Now, I don't know what's playing into that. I don't know if you're changing your size, which I know you've mentioned that you've already done. But is this because you go through certain periods where your EA is more active? So, volatile conditions. Okay, because I increase positions a bit when I win and lower when I start losing. Okay, so you're basically, it's just a risk management thing that's causing this, which again makes sense. For anybody who doesn't understand what value at risk is, I've just dropped some videos into the Discord in the Darwinex 101 channel. There's quite a few videos already on value at risk and the risk engine and how it all works. So I would recommend go and watch them. They're literally a minute long, if that, on some of them. But I've tried to break them down into the most simplistic kind of explanations that I could possibly do. And there's more videos coming, so stay tuned for those as well. But yeah, I wouldn't be too concerned at this point. Again, like, you've not hit 30%, which is great. 30% value at risk is generally where we kind of, wave the red flag and say, listen, historically, what we've seen over the past 13 years of Darwinex being around is that if you operate at above a 30% value at risk, generally you will blow up at some point, or you'll come into a huge drawdown that will just be really, really difficult to come back from. So the fact you've stayed beneath that is fantastic. I would try and reduce the volatility as much as you can. But again, if it's coming for, if that's just an accumulation of all your risk management decisions, I wouldn't be too concerned. For example, Typhoon actually uses the VAR chart to trade. I don't know what he's doing. He knows more about value at risk than I do, so I'm not even going to pretend I understand. But he will basically trade value at risk. I don't know how it works. I don't know what he does, but it does work. So I'm not too concerned because I know it's going to fluctuate. I just try and reduce that fluctuations as much as you possibly can. Okay, let's take a look at your investable attributes. So as I mentioned at the beginning of the session, you can view your Darwinex 0 Darwins on Darwinex.com. And for those of you who are unaware, Darwinex.com is kind of the parent company of Darwinex 0, or sister company, however you want to call it. Darwinex is a FCA regulated broker and asset manager, and we also have a hedge fund, and that's where Darwinex was born. right? Darwinix Zero has only been around for a couple of years, but Darwinex has been around for 13 years. We actually celebrated the 13th birthday last month. I think I was in Madrid for it. Anyway, Darwinex Zero is kind of a completely different system, but all the technology is the same. Your Darwin is 4-ticker or 4-letter ticker, whereas on Darwinex, it's a 3-letter ticker and you're trading with your own capital. So it's kind of the live version of Darwinex Zero. The point of Zero is that it's literally zero risk. You don't have to risk your own money. You don't have to go out and network with investors. It's kind of a full-scale solution for you as a trader. Anyway, all of that to say, if you go onto Darwinex.com, you can log in with your D0 credentials, or you can create an account on Darwinex.com. You can also be an investor, so you can invest into your own trading strategy or into other traders. Of course, capital is at risk and past performance is not indicative of future results. So if you are doing that, you are taking on risk. However, you can just use the platform to view your own Darwin. So once you've logged in, if you just go to darwinex.com/Darwin/your ticker, sometimes it doesn't work. So if it doesn't work, just put a hashtag and it will work. Technology, I don't know why, but it, that's what it does. Now on darwinex.com, let me zoom in slightly because I think I'm a little bit zoomed out there. We have these things up here, which are called investable attributes, and they basically measure certain little metrics or individual variables on your trading strategy that you can take a look at as well. So if we take a look at the first one, which is experience, you can see it's a score 10 out of 10. Now we mark all of these out of 10, and you can see you have like a little corresponding color and the circles filled up based on your score, right? So 5, you'd be amber, halfway filled up. 10, fully green, full circle. Experience literally only measures how much data we have on you, how accurate is your record. And what I mean by that is, can we say that the record that we have is going to be accurate for the next 2 years? Because if an investor is coming on, we don't want to be saying basically, put all of your money into this guy. We've got 1 month's track record. We don't know if he's going to perform the same for the next year, 2 years, 10 years. So experience is literally just a measure of how many trades you've taken and how long your record is. Okay, so for swing traders, it's probably going to take you a bit longer to get a higher experience level because you're taking less trades and it's over a long period of time. Whereas a scalper or an expert advisor, someone like the Rango, you've got the record that's 2 years long and you've already got a 10 out of 10 score. We don't really need more data to say that, yeah, he's going to perform like this for another year, because we kind of know already your behavior is very recognizable, if that makes sense, and we can model that moving forward. So we know accurately that you're not just going to blow up one day because you've changed something. Market correlation. This shows your efficacy at trading both directions in the market. So can you go long as effectively as you go short, and vice versa? Now, usually traders have a pretty high score anyway. I would say most traders are above an 8.5. The only people who I really see struggle with this, I wouldn't say struggle with it, I just have a low score, are traders who go long only. So like long only stock and ETF traders, because they're of course not going to trade a bear market the same way that they would trade a bull market. In a bull market, they're going to be, making money hand over fist. In a bear market, they're obviously going to be struggling to keep up with, or they might have better risk-adjusted returns than the S&P, for example, but they're still not going to perform the way that they did during a bull run. So they'll have a pretty poor market correlation score. And the reason that we track this is because investors obviously want to be invested into a trader that they know is going to perform all of the time, or at least if they're not going to perform all the time, they know that somebody manages their risk well and that they have a long enough record to back the fact that they will have periods where their returns will be lower. So for example, if I'm investing into a stock and ETF trader, I want to know that, even after a bear market, they're going to bounce back. I don't just want to sit with my money stagnant for 12 months when I've got a trader who can kill it both directions. Nothing to worry about here. You got a 9.3 out of 10 score. You do have a relatively high long exposure. Like I mentioned, I think 64%, which would probably indicate why it's not a 10 out of 10. But again, it's nothing to worry about. I would say anything above 8 is pretty safe. But usually people are above 8.5. So next is risk stability. Now you have got a 5.6 out of 10, and this is basically just your VAR chart. So again, what we've already looked at. And I think it's literally just because of the volatility of it. So this is only showing a 12-month period, which is quite annoying because on Darwinex here it shows the whole chunk. But it's nothing to do with the percentage. It's all to do with the stability and the consistency of this. So I always say to people, unless you've got a ridiculously high value of risk, don't worry about the number. If it's 10%, 1%, 20%, that's not what we're looking for. What we're looking for is somebody who's stable, consistent, and that the risk engine can, consistently copy size well. What we don't want is somebody who's completely sporadic, and 1 minute they'll be taking a 1 lot, next minute they'll be taking 100 lot, because the risk engine is going to struggle to keep up, and it will try and find a happy medium, and it's not always going to work out the way you want it to. The next attribute is risk adjustment. So you've got a 10 out of 10 score on this. And this basically shows how often the risk engine has intervened in your trades. So for those who aren't aware, the risk engine can get involved if your exposure gets too great. Now, again, I did record a video on this where I explained it in under a minute, and it's probably one of the best explanations I've seen from us as a business on how this works. But we basically work out your deleverage per position, so not per trade. Your position is kind of a synthetic position built up of all of your trades. We work out the deleverage. We then look at how that's affected your value at risk, and if your deleverage is increasing over the limit that we would assume, the risk engine can intervene and start closing some of that exposure. Whenever you're in a trade, your Darwin will always be in a trade. It's never going to close 100% of the position because it will always be in that trade, but it can close a certain amount. You've got a 10 out of 10. I can't even see any red or amber dots that would indicate that it's ever closed any of your position. So I would like to think that it's not done it. You can see, yeah, I can't find any dots. You have yellow or amber dots and red dots if there is any times where the risk engine has got involved and closed a certain amount of exposure, but you've got none. Now the next two are interesting ones. And again, what I'm going to do for these, well, I'm going to do it for all of these attributes. I'm going to record 1-minute videos where I explain it, because I really struggle to explain the open and close strategy. And I try and do it a different way every week, which probably doesn't help me, to be honest. But they are custom metrics built by Javier Colon, the founder of Darwinex. And it basically measures your ability of, or your efficacy of opening and closing trades from a time perspective. So what it does is it looks at your average trade duration, and let's, for this example, use 10 hours because it's the easiest number to divide. So we'll say your average trade duration is 10 hours. And then it will measure how your performance would differ if you entered the market or closed your trade 10, 20, 30, 40, or 50% before or after. So that would equate to 5 hours before or 5 hours after, or 4 hours, 3 hours, 2 hours, and 1 hour. And it will plot it on a chart. So what we can see, they both show on the same screen. So no matter whether you click open or close, they will show on the same screen. Now your open strategy, there's quite a big discrepancy here. So you're currently ranked 7th out of the 11 options. So the 11 options, again, is those 10 to 50% and minus 10 to minus 50%, and the way you open your trades. So this could be relative to an hour. It could be 10 hours. It's all dependent on your average trade duration. Now you can see if you entered the market anytime better or earlier than you do, you would be way outperforming your actual Darwin's performance. Now, this is quite difficult to take into account. I always think preempting moves is harder than if it's saying that you enter trades too early, for example. That's easy because you just wait for additional confirmation. You'll put filters in and you'll wait. But when it's saying that you do better by entering early, sometimes you have to remove some parts of your system. So you have to remove some trade blockers or some confirmation, because it's literally telling you would perform so much better if you got in the market 10% or 10% of your average trade duration earlier. So again, the example of 10 hours, that would be an hour earlier. So if I know that a trade's setting up in the next couple of hours, I go, okay, well, I'm probably going to enter this at 12, but I'm going to enter it at 11. Again, it's so difficult to get that into something that you can actually implement. but it's always worth thinking about and always worth doing any testing if you can. Yeah, exactly. This is the thing, Rango, and it's even more difficult in your position. Again, it's easier for me. I take a couple of trades a week, sometimes if that. You know, and I've got areas highlighted so I can kind of preempt moves. For somebody like yourself who has such a high trade frequency, it's a little bit trickier. But again, this is a custom metric that was built by Javier Colon, so it isn't like it's something easy to go out and implement. But it is basically saying over the course of yeah. The Rango said, just for reference, he put, how do I know the market will move at the level of my stop order? You know, I don't have a crystal ball, which is completely fair. It's just it's kind of one of those to highlight to you, okay, are you entering too late? Are you entering too early? You don't even have to do anything about it, but it's good to know where you are. Because this is basically saying if you got into the market earlier than you do, you would be more profitable. You can take away from that what you will. You know, again, you might not be able to do anything with it because, like you say, you don't have a crystal ball, but it's literally staring you in the face saying get into the market earlier and you would be performing better. Now, of course, that is hypothetical. It's taking a look at all of your past trades, how you would formulate that and implement it into kind of a future mechanism moving forward. I don't know. I also don't have a crystal ball, so I don't have the answers for you. I'm just telling you what I see on the screen. Yeah, some ideas can be found based on this. Exactly. I actually use this because I have a really high, or at least I used to, I haven't checked it in a while. I was really high. I think I was #1 on my open strategy. And that's because I generally have a low adverse excursion. I tend to pick good entries, but my closing strategy was like last. I was awful. So I didn't run trades for long enough. And I don't think I was last. I think I was probably mid-table, but it highlighted to me that I knew I wasn't holding trades long enough, but I was doing nothing about it. When I see that I would be performing so much better and it's black and white in my face, I'm like, okay, I just need to start holding trades. I need to start trusting my initial targets and getting rid of that kind of, you know, oh, I need to close this trade because I'm up 1 hour or something, or I'm up $1,000, I need to get out. It's kind of like, okay, well, your data tells you to stay in the position. And it is the same. It is the same thing on the close side. Your strategies actually last, so you could hold your trades for longer. You could cut them earlier, and you'd be performing better than you do now. That generally means I would presume that you trade and it has a trailing stop mechanism or something, because that would usually indicate that you have trailing stops. Are great from a risk management perspective, but when it comes to this variable, it's shocking. I could be wrong. You might not have a trailing stop. Catching a bit, Rango. It's been a pleasure, dude. At least I know I haven't got to speak to a robot trader anymore. I can generalize it. I can generalize it to discretionary traders. But the rest of the session will be on YouTube or X. You won't miss much. There's just a couple of interesting attributes that we'll take a look into. But I'm going to hound you for an interview as well. So I'll catch you in a bit, dude. Next, we have positive, negative, and duration consistency. It's exactly the same as what we looked at on Darwinex 0 with the duration versus profit, so I'm not going to go over it again, and they all show the same thing. Loss aversion is your excursion chart, which again we've already done on Darwinex 0, so I'm not going to go over that again. We then have two more to take a look at. So we have performance, which is our in-house Monte Carlo test. Now, this basically tests your strategy against 10,000 other uncorrelated systems all operating at the same risk, which is a bit of a mouthful to say, but it's basically saying that your strategy is performing at X level against 10,000 other systems that take the same amount of risk exposure as you. Now, we can see the Rango is currently sat on the 69th percentile, which basically means he's outperforming 6,967 other traders to generate his return. You can't really take anything away from this in terms of things to go and implement or test. The reason I like this metric is because when you do implement something, you should always refer back to this chart, because you're going to get pretty much instant feedback straight away telling you whether the decision that you made, whether, you know, whatever it was that you decided to change or amend or fiddle with, it will show you, did it pay off? Is it worth it? Or should you revert back to your original strategy? Like I say, it's a Monte Carlo test, so it's testing against so many random uncorrelated systems that you kind of get that instant answer. And last but not least, possibly the most interesting metric that we have, and I always advise traders to go and look at this for themselves. There's no kind of clear-cut answer I can give you on how to improve this. There's so many different things that you can do, and sometimes it's just using a bit of common sense in terms of trading higher liquid assets at higher liquid times of day, running trades for longer, having wider stop sizes. All to say that this measures your capacity as a trader, so how much investment you can take on, otherwise known as your alpha cap. Okay, so Rango's got 8.1 out of 10, which tells me his alpha cap is pretty high. He's trading highly liquid assets anyway. We know that he's not taking trades on, you know, exotic FX pairs. It's all like liquid indices, gold, highly liquid FX pairs, and all that sort of good stuff. Now, what we do to work out your alpha cap is we look at the toxicity flow of your orders. We then figure out how much the divergence would be between your strategy and the investor's strategy, or the investor's pot of money, based on how much capital they allocate to the strategy, all according to the toxicity flow of your orders. So we work out what the slippage would be and what their return would be if they were getting slipped X amount of pips. We actually cut your strategy off to investors if we can't guarantee that they will be under a 0.2 pip slippage on each trade, because their return would be completely different to yours. So if we take a look at the Rango's divergence chart, this shows how different their... Oh, wow. That's a way bigger diversion than what I would have thought looking at his score of 8.1. But as I said, this measures the investor's return if they were getting 0.2 pip slippage, 0.5 pip slippage, 1 pip slippage, and 2 pip slippage. So you can see the Rango is up 42.38% as of Monday this week. Now, if an investor had allocated capital to him from day one and was getting slipped 2 pips on every trade, the investor would actually be down 14.21%. So we couldn't advertise to an investor saying this guy's made 42% over 2 years if we knew that the investor was going to get slipped and they would be getting a negative return of 15% almost over 2 years. Our asset management license would be gone. Hence why we cut traders off after the 0.2 pip slippage. Now, we use this information to figure out your alpha cap, which is down here, capacity max estimated investment. There's always a pre-spike as the trader's in calibration phase. I don't know why. I guess it's as it's calibrating how much capital you can actually manage. So there's a bit of a spike. And then it does evolve over time. So when you make different decisions, when you change things in your strategy, it will adapt. For example, like I say, if you drop exotic pairs and increase your exposure on US majors, for example, your capacity may grow. Exponentials asked, are we looking at the Rango's trading account, and how do I get about having you look into mine? I have 600 mil capacity and in gold. Exponential, great question. Yes, this is the Rango. He was in the session. He left just before you did. He had to run. If you're around next week, we can do this session next week, and I can use your Darwin. It'll be great to do that because you are in gold. If not, if you're not around, let me know. I can either do the session on your Darwin and you can watch a recording, or we can do it privately. So we can either jump on a one-to-one, or I'll record a video and we can look at it that way. Just depends how you want to do. GNN. Okay. Send me a DM with that, and we'll either look at it together, or I'll do it on next week's session and send you the link to it. So we can see at the minute, the Rango's max investment or alpha cap is 76 million. Now, that's a pretty comfortable number in the fact that I don't think he's probably ever going to have an issue, right? 76 million, there's not many traders worldwide who are managing more than 76 million. Of course, there are some, but they're pretty much all, you know, in professional environments, trading at hedge funds and stuff like that. As a retail trader, I don't think the Rango will ever have an issue of you know, having too much investor capital, because he's got such a high alpha cap. If your alpha cap's like 200k, you've got an issue. You need to figure out how to get your strategy more open to accepting investor capital. Again, sometimes it can be common sense things like trading the euro dollar instead of euro Aussie, trading with a I don't know, 30 pip stop instead of a 3 pip stop, trading in the European session as opposed to trading overnight in the Asian session. There's so many different things, but it all comes down to the individual trader. So there's not kind of a one thing fixes all. It's also one thing that I always say is never an issue until it is. So you're never going to worry about your alpha cap until it becomes an issue. And at that point, if you've got an investor going, I'm willing to give you 10 million to trade with, but you can only take 2 million, that's a big problem. And you don't want it to come to that. But of course, you know, that's going to take time. So you do have, or usually at least, you have time to figure it out and to work on it. We also have a K-base. Again, I'm going to make videos on these, but we do have a K-base, which does give you some pointers in things that you can do or you can implement or test. But again, it all goes back to your toxicity flow. What is the toxicity percentage of your orders that you place? And that's how we measure your divergence and therefore measure your alpha cap. And that brings us to the end of the session. So I know the Rango's not here anymore. I'm hoping he watches the rest of it because we only had one more metric to cover. Exponential, send me a direct message, and like I say, we'll either do it in next week's session because I do these on a weekly basis. Okay, that's cool. Exponential said we'll DM you and think I'll be able to attend next week's session, but got to look at my schedule. Just let me know, dude. If you can't attend next week, then we'll figure something out, and I'll either do it privately or I'll send you a video or something like that. It's absolutely fine. But other than that, guys, I hope this session has been insightful. Again, I will be back doing this next Wednesday, so make sure you don't miss out. If you want your Darwin analyzed, let me know. Come to the session and put it in the chat. If you can't make these sessions or you would rather me take a look privately, just send me a direct message. I'm always open to do it privately or to send you a video. I know not everybody wants their ticker known, so I'm always happy to do that. But guys, it's been great to speak to you all. Thank you for the questions. Thank you for the feedback, Rango. And I will catch you tomorrow. Peace out, guys.